saying the three things I was going to focus on today was our aggregate agricultural production and export figures, talking a little bit more about cattle and sheep exports and production, and then just making a few observations about what we've seen change since we did our forecasts in March. 2021, in March, we were forecasting record high production of $66 billion. That's an 8% increase on the year before. And what was driving that was the favourable climatic conditions that we've had. It actually led to the second largest winter crop that we've ever had. And thank you very much. And as part of that, it also supported pasture growth, which enabled producers to be able to restock their herds and flocks. As a result of that restocking, though, we saw meat production fall, and the consequence that prices rose. So all of that feeding through meant that exports fell about 4% to $46 billion in 2021. Those results are really impressive, particularly when you think about the conditions in which they were achieved. COVID-19 was causing economic disruption on a scale that very few of us have ever lived through. As governments were trying to stop the spread of COVID-19, logistics and freight came under increased pressure, and businesses had to manage supply chain risks to an extent that they'd never had to before. For domestic producers, they had to manage labour supply challenges as a result of lack of access to seasonal workers and working holiday makers. And many producers and food manufacturers had to navigate state border closures and unexpected consumer demand from sudden lockdowns. Thinking about the upcoming year, 2021-22, we're expecting agricultural production to soften slightly to $63 billion. Again, we're expecting positive above average rainfall in that year, but not as favourable as the preceding year. So we're not expecting another record performance. Similarly, though, the positive weather conditions mean that pasture growth will continue and will continue to support efforts to restock. For 2021-22, we're expecting exports to go up 6% to $49 billion, and that's being driven by higher production across the livestock sector, particularly in dairy and natural fibres, but also rising prices in natural fibres, as we expect to see a broader economic recovery globally, which will increase demand for those. In terms of our forecasts specifically for beef and sheep meat, obviously international meat prices, thank you very much, are dominated by the African swine fever and China's imports for meat and protein as a result. In March, we were seeing some signs of recovery from China. We were seeing feed grain imports and retail meat prices actually returning to pre-African swine fever levels. But there were some things which didn't fit that story, like sale prices remaining quite high. So there has been a lot of uncertainty over the pace of recovery of the Chinese pig herd. Thinking domestically, again, the restocking story was driving up higher prices than we would normally experience. And with international prices being high but steady, but rising domestic prices, we were actually seeing margins of meat processors and feedlotters being squeezed. And as a result of this, some of those processors were actually reducing their operational capability. We're expecting to see beef and cattle exports pick up next year. This is largely due to herd rebuilding, occurring a bit slower than it has been previously. And what this should do is improve cattle availability and lower domestic cattle prices. And again, those lower prices would support competitiveness of our exports into the year. For sheep and mutton, a lot of similarities. We were expecting to see production down as a result of producers retaining female lambs for flock rebuilding. And we're also expecting prices to soften as both supply shortages and demand from African swine fever abates. So that was all what we thought in March. So the big questions are, what's changed since then? From a global perspective, the World Economic Outlook's actually looking better than it was at March. Since then, we've had the IMF release its updated forecast, and it projects stronger growth in both 2021 and 2022. And that's important because that affects the economic situation of our major trading partners, and how much they might want to.
As we talk, I think
they might want to import going forward. The stronger growth numbers reflect stronger fiscal support from governments than what had previously been known about. And it also had expectations of a vaccine-supported recovery in the second half of 2021. Obviously, though, and particularly at this point in the global economic cycle, the outlook remains really uncertain. We don't know how effective COVID vaccines will be to new strains of the virus. And it's also uncertain how quickly some economies will recover and how much scarring there'll be in the economy. One of the really interesting things going on in the global economy, though, is for a lot of economies, including Australia, households have actually built up their savings over the last year. So if we see a change in consumer sentiment and more positive occurrences, we might actually see those savings released, which would further support consumer spending. Thinking a little bit more about what we're seeing, in March we were expecting strong competition from Brazil and the US. Since then, a number of forecasters are actually expecting more Brazilian exports to come on, and that's largely a result of Brazilian processors actually redirecting domestic consumption to international markets. Got to balance that though with we're also hearing reports of some Brazilian processors actually not able to access cattle, and as a result, unable to follow through with the exports. The US, very different story. It's got drought conditions at the moment in southwest and north United States, which has caused a deterioration in pasture and range conditions. USDA analysis suggests about 44% of pastures are either poor or very poor. And that compares to 16% this time last year. And so with conditions in the United States expected to remain dry and domestic corn prices in the United States at an 8-year high, there's actually a real risk that the US cattle herd could enter a liquidation phase, which basically means them trying to get a lot more cattle into global markets, which, if that were to happen, would have a downward pressure on international prices. Domestically, we've been surprised, I think it's fair to say, as we've seen record prices for a lot of young cattle. And that's been supported because of the really good rainfall we had in March, which has encouraged the restocking. So we're probably seeing stronger competition between producers and processors than we might have expected. While we'd still expect prices to trend down over the next year, they're certainly trending down from a much higher level than previously anticipated. And those high domestic prices with, again, the sort of steady international prices are just further putting pressure on the margins of processors, but also for producers who might be buying young cattle at the moment. For sheep and lamb, there's a very similar restocking dynamic. We've got higher prices and reduced margins for processors, but definitely the pressure is not as acute as we're seeing in cattle. Furthermore, we'd expect any changes in China pig herd to probably have a stronger impact on mutton prices than we would on cattle, often because mutton is considered a substitute for some pork products in the Chinese market. So in summary, we're seeing a stronger global economy, the potential for more export competition and higher domestic prices going forward. What we're not seeing, though, is any change to the long-term drivers. So rising middle incomes globally, increased urbanisation, increased population growth, the drivers that are going to shape these markets in the longer term. So I might leave it there. I hope that's just giving you a bit of a snapshot of where we are and what we're seeing, and we'll continue to monitor markets, but very interested in the discussion